Welcome back to OnTheMoneyOptions.com Christmas Gift 2016. Today we look at a low-cost, low-risk method to enter a position. But before that, let's review the rules so far. Rule 1. Stop looking at the major indexes. They don't give you the information you need to accurately invest. Rule 2. Money is constantly in motion and across the sectors. Rule 3. Take new long positions in sectors that are outperforming both on an absolute and relative basis to the benchmark index. Rule 4. Take long positions in stocks that are outperforming their sectors, which is outperforming the benchmark on a relative index. And Rule 5. Pick the outperforming stocks using relative strength analysis. Now let's look at a method of entering a position called a calendar spread. In this example, I will compare this to purchasing the stock itself. This will help you understand how we are managing risk. The reason I'm not sharing this trade before the close on Friday is because you should never enter any new positions prior to a long holiday weekend. Anything can happen, and you get no benefit trading today, especially with options, because the floor traders lower the prices on Friday afternoon to take into consideration the time value decay over the holiday period. For our entry examples, we chose Transocean, symbol RIG, and Hess, symbol HES. Let's start with RIG. Before we get started, I need to remind you that standard option contracts are for 100 shares of stock, so I will compare each position to 100 shares of the stock. Transocean's current price is $14.85. Purchasing 100 shares of stock will cost you $1,485. A point that I want you to consider throughout this presentation is the amount of money you pay for any position is your total risk. So in this case, you're risking $1,485 to purchase 100 shares. Now let's build the calendar spread. We've established that RIG is moving upward, so we were looking for a low cost and therefore a low risk way to capture some of that upside. We're going to purchase a call option as the first leg. Going out to the May series, we're buying the May 16 call. This option gives us the right to buy RIG at $16 per share anytime between now and the May expiration. At the same time, we're going to sell a January 16 call. This creates the obligation for you to deliver the stock at $16 per share. This could happen if the stock goes well above $16, but your May 16 call will cover this position. Don't worry, I'll show you what to do with it if it all goes above 16. Actually, we want it to move up. The total cost of the calendar spread is $1 per share, so you're going to risk $100 with this position. You will be controlling 100 shares of RIG for only $100 of total risk versus the $1,485 risk purchasing the stock. This is the profit chart of the calendar position. The break-even points are marked on the chart with vertical horizontal lines. So if the price is anywhere between $14.49 and $17.70 at the January expiration, this position will have a profit. Now let's do the same type of trade with Hess. Hess is trading at $63.56 per share. So purchasing 100 shares would cost you $6,356. This would be your total risk. Now let's compare the calendar spread. First, we purchased the May 2017 65 call. The option gives us the right to buy Hess at $65 per share anywhere between now and the May expiration. At the same time, we're going to sell the January 2017 65 call. This creates an obligation for you to deliver the stock at $65 per share. This could also happen if the stock goes above that price, but your May 65 call will cover this position. The total cost of the Hess May-January calendar call is $3.65 per share, or $365 total for the contract. This is your risk. The profit graph shows the profit range is between $60.93 and $69.87. In the next video, I'll show you what to do when the stock moves in our favor. Until then, this is Doc with OnTheMoneyOptions.com saying Merry Christmas and stay hedged.